Another hedge fund has just revealed their AMC short position, and I personally believe that AQR Capital Management will be the next fund going bankrupt for shorting AMC. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Cliff Asness has just revealed his AMC short position, daring all of the meme stock maniacs to try and hurt them. Now, I personally thought there were some very interesting parts of this interview that I really picked up on. Cliff started by saying that AMC is terrible for everything that he cares about, and he dared the apes to try and come after him. But he then told CNBC that it's such a small short position, around 12 basis points or 0.12% of his entire portfolio, that it won't impact his firm's performance either way. Now, both of those sound very counterintuitive. If he has such a small position and doesn't care about AMC whatsoever, why is AMC terrible for everything that he cares about? I personally don't believe that Cliff is telling the whole truth about the true size of his AMC short position. Obviously, from the 13F filings, we can see that he does hold around 180,000 AMC shares, but obviously short positions don't have to be disclosed. Now, he says that his AMC short position is around 12 basis points of his entire portfolio, but that position isn't reported, this is entirely unverifiable, and his true short position may be significantly larger. I could say that I'm holding 5 billion shares of AMC, but because I don't have to report my position, that position is unverifiable, and I could obviously be lying. And if AMC is terrible on everything that he cares about, it's very unlikely that his true short position is only 12 basis points of his entire portfolio. Now, you may have also seen that AQR Capital Management actually lost $43 billion during the pandemic in 2020. It says billionaire investor Cliff Asness spent his quarantine watching $43 billion disappear. AQR Capital used to manage $186 billion at the end of 2019, but subsequently updated their website to now only managing $143 billion. Cliff Asness then spent the rest of 2020 chopping staff, cutting around 15 to 20% of its headcount. In 2020, AQR suffered massive losses across its portfolio and had to slash staff by 10 to potentially 20%. They also suffered massive losses in 2019 as well, being down 34%. AQR then spent 2021 suffering massive client investor withdrawals. It says AQR hedge fund suffered $10 billion in client outflows. One of their individual funds, AQR Managed Futures Strategy Fund, was managing around $12 billion in 2017, but it fell to only $1.5 billion at the end of 2021. Clearly, AQR has been losing significant portions of their assets during 2020 and during 2021, while meme stocks were running out of control. And therefore, I think that even though Cliff Asness has only recently announced his short position on AMC, I personally think he's been holding this position for a lot longer, and this short position is much bigger than he's letting on. Considering he's already lost tens of billions of dollars, he's already chopped headcount by 10 to 20%, and he's already suffering giant investor withdrawals, it wouldn't surprise me if AQR's bankruptcy is just around the corner. And that's why I went on CNBC as a final Hail Mary to try and taunt the apes one final time before going bankrupt. And guys, if you didn't already know, from Moomoo's latest customer agreement, they state they do not sell your order flow. They state they don't lend out your shares, and they state they don't route your trades through market makers like Citadel. They have their own clearing broker, Futu Incorporated, which does also not sell your order flow. And therefore, Moomoo is brilliant for buying AMC shares. And right now, if you sign up to Moomoo using the link in the description below, you can currently get 10 free stocks worth up to a total of $25,000 and a guaranteed free share of Lucid on top of that. Riz also tweeted this video showing AQR's poor performance over the last 1, 3, 5 and 10 years. Most of his funds have only returned between 1 to 11%, and many of his funds have actually suffered losses on average over the last 10 years. And as Rizzo tweeted, he said it's not quite the $145 billion asset under management giant fund. He said it's more like a slush fund for Citadel and Ken Griffin. It also seems that Citadel have poached a number of top employees directly from AQR Capital Management, and therefore it seems likely that Cliff Asness and Ken Griffin are working very closely together. The last hedge fund manager that used to work closely with Ken Griffin, Gabe Plotkin, obviously recently went bankrupt, or Melvin Capital Management has recently had to close their doors. And I do think we're going to continue to see more bankruptcies of more and more hedge funds over the coming weeks and the coming few months. Peter Han recently tweeted about JP Morgan chopping 1,000 staff in their mortgage business and said that JP Morgan won't be the only one. He said at some point the dominoes will fall and these major banks will potentially end up going bankrupt and cutting more and more staff. Goldie Boy replied saying, would these banks like Bank of America, Credit Suisse, JP Morgan and many others actually fall? As in, would the government let millions of personal saving accounts just be destroyed? Peter replied by saying that England recently said they believe that no bank is too big to fail. In the US, I imagine they will try to do what was done back in 2008, and that's try to find buyers for parts of the businesses. He said, for example, it said that Bank of America is already quietly selling off parts of their fund or parts of the bank, but he can't verify it, but it does seem possible. Now, obviously, if millions of Americans do lose their savings, it will be partially protected by FDIC insurance. Obviously, in the US, it covers up to $250,000 per bank account per bank. In Canada, that runs up to $100,000, and in the UK, £85,000. That's why I've also suggested to spread your savings and to spread your AMC squeeze money between multiple different bank accounts. In case some of these major banks do end up going under, you will still be fully protected by the insurance by holding your money in various different bank accounts at various different institutions. The New York Post announced that JP Morgan Chase is laying off hundreds of employees in its home lending business and reassigning hundreds more this week. And he said our staffing decisions this week was a result of cyclical changes in the mortgage market, aka mortgages and the housing market now beginning to crash. They've said last week the Federal Reserve hiked interest rates by 0.75 percentage point, the largest increase since 1994. But Unusual Wales has also tweeted saying that Jerome Powell has recently said that we will not take a 100 basis point rate hike off the table. If a 75 basis point rate hike is enough to start crashing the mortgage market and the housing market, I can only imagine the damage a 100 basis point rate hike will end up doing. On top of that, real estate brokers Compass and Redfin also said last week they would also be cutting jobs as home buying demand was slowing due to recent rising mortgage rates. In May, US existing home sales tumbled to a 2-year low as median house prices jumped to a record high. Right now we have house prices continuing to rise while mortgage rates are also rising while inflation is still rising as well. Basically meaning that Americans are going to struggle affording homes. This is already being seen as many homes on the market at the moment are being slashed massively in price to try and force a faster sale. I personally believe that this is the start of the gully or the start of the housing market crash that will end up wiping massive amounts off the housing market. Something that I also found very, very interesting was this tweet from Captain Jim James. He said, warning, I missed something earlier today that I rarely see. He said there has been no bid in the market, aka very little buying volume. He said none. And he said this means there has only been a short covering rally in the S&P 500. He said the buying volume has almost been 100% pure short covering. We can see here last time the market started to recover there was buying volume, but over the last few weeks as the market took another tumble and started to recover, there has actually been zero buying volume. The only reason we've seen green days in the S&P 500 over the last few days is because shorts are starting to cover their profitable S&P 500 short positions. And therefore it won't be long until they reload those short positions once again and the market continues to tumble. You'll know that a few months ago I drew this downward trending line on the S&P 500 chart. Obviously over the last week or two the market did slightly recover, it then fell below this downward trending line again quite significantly and we're now seeing a pop back up towards the line, and I do think over the next few weeks the market will continue to fall further and further following this downward trending line. line. I do think over the next week or two the S&P 500 will fall to around the 350 mark, likely pop back up to go and respect the line again, and then continue falling. Now obviously a number of major banks have their targets around the 350, the 320 and the 300 point line, but we could see the S&P 500 falling even further. And every single day we continue to see the S&P 500 falling, it means we're one day closer to these hedge funds being liquidated and one day closer to causing the AMC squeeze. So guys, be sure to let me know what you think down in the comments below. And also guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.